You're being told the housing market is stabilizing, that prices are holding, that the worst already passed. National averages look calm enough, and headlines suggest buyers and sellers are finally finding balance. But that surface calm is exactly how major housing breakdowns begin. Not with panic, not with crashes, but with quiet disconnects that most people don't notice until they're already trapped inside them. The mistake people keep making in 2025 is assuming housing collapses happen all at once. They don't. They happen locally, unevenly, and silently. One city freezes while another still looks strong. One neighborhood stalls while another keeps selling. And by the time national data confirms what's happening, the damage is already done for the people who bought near the top, believing the rules still worked the way they used to. What's different now is that the math has changed underneath the market. Prices were set during an extraordinary period of cheap money, intense migration, and emotional urgency. That environment no longer exists. Interest rates reset the monthly payment. Insurance, taxes, and maintenance kept rising, and wages never caught up. The result isn't a dramatic collapse. It's friction. Homes take longer to sell. Buyers hesitate. Sellers resist. Inventory quietly builds. This is the moment everyone misses because it doesn't feel like a crisis. Yet. The signs don't show up as falling prices first. They show up as stalled deals, repeated price cuts, incentives replacing bidding wars, and buyers walking away without urgency. Confidence erodes before values do. This video isn't about fear or prediction. It's about recognizing where the market is already breaking down city by city, even while national averages hide it. If you understand how these early fractures form, you stop reacting late and start seeing risk early. So before the headlines catch up, before sentiment turns, and before people agree something is wrong, we're going to walk through the 10 U.S. cities where the 2025 housing crash has already begun, quietly, unevenly, and in plain sight. Subscribe and hit the bell. Not for hype, but because timing matters more than opinion in markets like this. Most people look for crashes in the wrong place. They wait for headlines, emergency rate cuts, or dramatic price drops. But housing markets don't fail from shock alone. They fail when the structure underneath them stops supporting the weight placed on it. That process is quieter, slower, and far more dangerous for anyone relying on outdated assumptions. The first failure point is affordability compression. When prices rise faster than incomes for too long, demand doesn't disappear. It becomes fragile. Buyers stretch. Savings shrink. Monthly payments consume flexibility. The market keeps moving, but only because people are overextending. Once interest rates rise or costs increase even slightly, that fragile demand pulls back, all at once. Not violently, but decisively. The second pressure is ownership cost stacking. Mortgages don't exist in isolation. Taxes rise as municipalities chase revenue. Insurance premiums climb with climate risk, crime exposure, and replacement costs. Maintenance becomes more expensive as labor and materials inflate. Individually, these costs look manageable. Together, they quietly price out the next buyer. Listings don't collapse in price immediately. They just stop moving. Then comes inventory imbalance. This isn't about massive oversupply, it's about absorption. When homes are listed faster than qualified buyers can absorb them, the market stalls. Sellers wait, then they reduce. Then they offer incentives. Price cuts appear not as headlines, but as patterns. Once buyers sense leverage, urgency disappears. Another overlooked trigger is buyer psychology reversal. During boom phases, buyers fear missing out. During breakdown phases, they fear being stuck. That shift changes behavior overnight. Buyers stop asking how fast they need to act and start asking how safe it is to wait. When waiting feels rational, momentum dies. Finally, there's the role of expectation lag. Sellers anchor to peak values. Builders plan based on yesterday's demand. Governments budget on projected growth. When reality changes faster than expectations, friction builds everywhere at once. Transactions slow, financing tightens, and price discovery becomes painful. What matters most is that none of these signals require panic. Markets don't need fear to break. They only need misalignment. When prices, costs, incomes, and psychology stop moving together, the system loses balance. This framework is what will apply city by city. Different locations break for different reasons, but the mechanics stay the same. Once you see this pattern, you stop guessing and start diagnosing. And that's the difference between reacting late and protecting yourself early. Stay with me. This is where the cracks start to become visible. This is where the story becomes dangerous because nothing looks broken yet. These are cities that still function, still transact, still feel normal. And that normalcy is exactly what hides the damage forming underneath. Number 10 is Birmingham, Alabama. On the surface, Birmingham appears insulated. Home prices are lower than national averages. Inventory isn't exploding. There was no wild speculative frenzy during the boom. But that's precisely the issue. This market didn't have excess momentum to absorb the shock that followed. As interest rates rose, affordability didn't collapse. Demand did. Buyers here are deeply payment sensitive. Even small increases in monthly costs thin the buyer pool dramatically. Zillow data shows longer days on market and quiet price reductions that don't make headlines. Sellers resist at first, anchored to peak-era expectations, but holding costs don't pause. Taxes, insurance, and maintenance keep accumulating. The result isn't a crash. It's a slow bleed. Homes sit just long enough to reset buyer expectations lower. Number 9 is Memphis, Tennessee. Memphis rode the national housing wave without the economic reinforcement to support it long-term. During the boom, prices rose faster than local wages, driven by investors and remote optimism rather than income growth. In 2025, that imbalance is reversing. Investors who once tolerated thin margins are exiting as rents soften and financing costs rise. Owner-occupant demand hasn't stepped in to replace them because affordability has already been stretched. Zillow trends show stagnation rather than collapse, but stagnation is enough. When appreciation stops, leverage becomes visible. Buyer psychology has shifted sharply. People are no longer asking how fast they can buy. They're asking whether prices will be lower in 6 months. That single question freezes momentum. Number 8 is Toledo, Ohio, and this city illustrates a critical pattern emerging across the Midwest. Toledo didn't experience a dramatic boom, but it did experience price acceleration disconnected from population growth. As rates climbed, demand normalized faster than sellers expected. Zillow data shows listings lingering and repeated price adjustments, especially in entry-level segments that once moved quickly. The issue here isn't oversupply, it's insufficient confidence. Buyers know inventory exists. They know sellers are adjusting. Waiting becomes rational, and when waiting feels safe, urgency disappears entirely. What connects these three cities is not speculation or excess construction. It's fragility. These markets rely on consistent participation to function. When participation thins, even modestly, the system loses balance. Prices don't collapse, but they stop behaving the way sellers expect. This stage is often misunderstood because it feels boring. No dramatic headlines, no visible distress, just longer timelines, quieter negotiations, and a growing gap between asking prices and executed sales. That gap is where markets turn. Another shared trait is income sensitivity. In these cities, buyers don't have the flexibility to absorb rising costs indefinitely. When insurance, taxes, or financing shift even slightly, demand responds immediately. That responsiveness accelerates adjustment. These cities matter because they represent the early fracture phase, the point where belief still exists, but math has started to disagree, where optimism sounds reasonable, but outcomes quietly weaken. Most people miss this phase because it doesn't feel urgent. But this is where outcomes get locked in. Once buyers realize they have leverage, they don't give it back easily. Once sellers accept slower timelines, pricing power erodes structurally. And once a market internalizes that appreciation is no longer guaranteed, behavior changes across the board. These aren't the worst markets yet. They're the warning layer, the places where the shift becomes visible first before pressure accelerates elsewhere. Stay with me, because from here on, the stress stops hiding. This is where the market stops whispering and starts leaving evidence. In these cities, the stress is no longer theoretical or hidden inside spreadsheets. You can see it, you can feel it, and buyers are reacting to it in real time. Number 7 is St. Louis, Missouri. For years, St. Louis was framed as stable and affordable, a place where housing felt grounded in local reality. But in 2025, that grounding is turning into gravity. Prices rose during the boom without corresponding income growth, and now demand is thinning fast. Zillow data shows growing inventory in key neighborhoods and listings that sit far longer than sellers expect. The problem isn't excess construction, it's confidence erosion. Buyers are cautious, running full cost calculations instead of assuming appreciation will smooth things out later. Property taxes, insurance, and maintenance costs weigh heavier here than price charts suggest. Sellers feel stuck between adjusting and waiting, and that hesitation creates visible stagnation. When markets lose momentum without gaining affordability, pressure builds quickly. Number 6 is Phoenix, Arizona, and this is where scale amplifies stress. Phoenix was one of the fastest-growing housing markets of the boom years, fueled by migration, investor demand, and cheap financing. That momentum masked structural limits. In 2025, those limits are showing. Inventory has climbed meaningfully, especially in newer subdivisions built for demand that no longer exist at the same intensity. Zillow trends reveal softening prices and widespread seller concessions. Builders are offering incentives quietly rather than cutting list prices publicly, but the effect is the same. Buyer urgency has vanished. People aren't racing anymore. They're comparing, waiting, negotiating. And when a market depends on speed to sustain prices, slowing down is destabilizing. Phoenix isn't collapsing, but it is recalibrating in public view. Number 5 is Tampa, Florida, a city that illustrates how lifestyle demand cracks under cost pressure. Tampa attracted massive inflows during the pandemic years, driven by migration, tax advantages, and climate appeal. Prices surged accordingly. But in 2025, the carrying costs are catching up. Insurance premiums have jumped. Property taxes have reset higher. HOA fees are rising across newer developments. Zillow data shows inventory building in price ranges that once moved instantly. Homes still sell, but only when priced realistically. Buyers are now running full ownership math instead of falling in love with the idea of Florida living. That shift matters. Lifestyle markets rely on emotion. When emotion gets replaced by spreadsheets, demand becomes conditional. What ties these three cities together is visibility. The stress is no longer hidden, behind optimism or averages. Listings sit. Price reductions normalize. Incentives return. Conversations change. Buyers ask different questions. Sellers hear, "We'll think about it," more often than offers. Another common thread is overhang. These markets added supply based on peak-era assumptions. That supply doesn't disappear when demand cools. It waits. And waiting inventory creates leverage for buyers, not sellers. Even modest overhang can reshape pricing behavior when confidence weakens. These cities also show how fast psychology flips. During the boom, hesitation felt risky. In 2025, urgency feels risky. Buyers worry less about missing out and more about overpaying. That inversion is powerful. It doesn't cause panic, but it drains momentum steadily. This phase often confuses people because life continues. Restaurants are full. Jobs exist. Homes are occupied. But housing markets don't need chaos to adjust. They only need friction. When transactions slow, feedback loops change. Appraisals lag. Comps reset. Expectations soften. These markets aren't broken beyond repair. But they are no longer protected by narrative. They're being priced by behavior again. And behavior has shifted decisively. This is the stage where denial usually cracks. Not because of headlines, but because lived experience stops matching past assumptions. When homes take months instead of days to sell, when concessions become normal, when buyers walk away comfortably, something fundamental has changed. And once that change takes hold, it doesn't reverse quickly. Stay with me, because from here, the pressure becomes structural. This is where the story stops being about cycles and starts being about ceilings. These cities aren't reacting to temporary slowdowns or sentiment shifts. They're running into hard constraints that permanently change how their housing markets function. In these places, belief no longer props up value. Structure does. And the structure is tightening. Number 4 is Las Vegas, Nevada, a city often praised as a miracle of efficiency. No place in the country conserves water more aggressively. Indoor water is recycled. Lawns are regulated. Usage is monitored down to the detail. On the surface, this looks like resilience. But efficiency without margin creates a different kind of risk. Nearly all of southern Nevada's water comes from a single system tied to the Colorado River. That system has already been stretched to its limits. Conservation has removed waste, not created abundance. Which means there is no buffer left. Growth continues, tourism continues, housing continues. But all of it rests on a system with zero slack. When a market operates this tightly, even small shocks carry outsized consequences. Buyers sense that fragility. They don't panic, but they hesitate. And hesitation is deadly to markets that rely on constant inflow to sustain prices. Number 3 is Scottsdale, Arizona, where scarcity doesn't disappear. It gets sorted. Scottsdale holds some of the strongest water rights in the region. And when drought intensified, the city made a clear choice: protect itself first. Nearby communities that relied on Scottsdale's surplus were cut off, forced to truck in water at extreme cost. That decision revealed the true operating logic of this market. Access is not universal. It is conditional. For housing, that matters deeply. Buying here isn't just about affluence or lifestyle. It's a bet that your position remains protected as scarcity deepens. That protection carries rising costs: infrastructure investments, political pressure, insurance adjustments, and long-term sustainability concerns. Markets built on exclusivity rather than abundance grow narrower over time. Wealth delays consequences, but it doesn't erase them. Number 2 is Phoenix, Arizona, and this is where structural limits became official. In 2023, state regulators halted new development approvals in areas dependent solely on groundwater after concluding there was no guaranteed long-term supply. That ruling changed the math permanently. This wasn't activist rhetoric or worst-case modeling. It was a government admission that growth assumptions no longer matched physical reality. For housing markets, growth isn't optional. Appreciation depends on expansion, new buyers, new demand, and new construction. When that pipeline is restricted, momentum fades even if prices don't collapse immediately. Existing homes still have water today, but their value depends on a future that has been partially canceled. Buyers feel that. Builders pause. Investors reassess. Confidence erodes quietly, not explosively. What connects these cities is finality. Las Vegas has no extra efficiency to unlock. Scottsdale has already shown how scarcity will be enforced. Phoenix has acknowledged limits in law, not theory. These aren't markets waiting for better conditions. They're markets adapting to boundaries. This is the point many people struggle to accept. Innovation, money, and ambition don't create water. They only redistribute what exists. When physical inputs become capped, housing markets stop behaving the way people expect them to. Prices don't soar endlessly. Growth narratives weaken. Time on market stretches. Risk premiums rise. These cities matter because they sit closest to the truth. They show what happens when belief collides with constraint and loses. They also show how fast narratives change once official limits are acknowledged. Buyers stop assuming upside. Sellers stop assuming recovery. Everyone starts calculating downside. That doesn't mean catastrophe is imminent. It means the rules have changed. Markets don't crash just because growth slows. They stagnate, compress, and reprice quietly over years. That process is slower, but often more damaging for people who entered late believing momentum was permanent. If you're buying into these markets, you're not just buying a home. You're buying into a system that has already admitted its ceiling. Understanding that doesn't require fear. It requires honesty. And honesty in housing is rare right before a structural shift becomes obvious. Stay with me, because the final city shows what happens when multiple limits converge at once. This is where the countdown stops feeling theoretical. Not because this place looks the worst on the surface, but because it reveals what happens when multiple pressures collide at once. Number 1 isn't just another struggling market. It's the clearest example of a system that has run out of room to absorb stress. New Jersey sits at the edge not due to climate headlines or sudden shocks, but because its buffers are gone. For decades, the state relied on density, proximity, and high incomes to justify rising costs. High taxes were framed as the price of stability. Older infrastructure was seen as mature rather than fragile. But by 2025, the math no longer works quietly enough to ignore. The state carries enormous fixed obligations. Pension commitments consume future growth before it arrives. Debt servicing limits flexibility. Taxes are already near the upper boundary of what households will tolerate before adjusting behavior. When a system reaches that point, every additional cost matters more than the last. Water infrastructure exposes this reality. Much of it is aging, leaky, and expensive to maintain. Deferred upgrades now require immediate funding. That funding doesn't arrive as a crisis announcement. It arrives as higher utility bills, rising property taxes, and constant assessments layered onto already stretched homeowners. Nothing breaks all at once. Pressure just keeps stacking. Housing feels this first. Buyers don't stop showing up overnight. They slow down. They calculate differently. Monthly costs matter more than list prices. Sellers resist adjustments, anchored to values from a period when margins were wider and assumptions felt safer. Transactions thin. Inventory lingers. Confidence drains. This is the betrayal. New Jersey was supposed to be insulated. Dense development meant efficiency. Established systems meant reliability. Proximity to major metros meant permanent demand. But resilience without flexibility is illusion. When growth is already spent servicing the past, there's nothing left to support the future. What makes New Jersey the warning isn't mismanagement alone. It's convergence. Aging infrastructure, fiscal exhaustion, tax pressure, population outflow, and housing strain all press at once. Even small population losses matter when the base supporting fixed costs shrinks. Raising taxes accelerates exits. Borrowing delays pain but deepens it. Choices narrow fast. This isn't a local story. It's the first domino. New Jersey shows what happens when systems operate without margin for too long. Collapse doesn't require drought or disaster. It only requires obligations that grow faster than capacity. That's why this matters beyond one state. Others carry similar burdens, just with more time left on the clock. Seeing this early isn't about fear. It's about recognition. Once you understand that math always wins, reputation loses its power. Subscribe and hit the bell. Because this isn't theoretical anymore. If there's one mistake people make when markets start to fracture, it's looking for a single villain. One bad policy, one interest rate decision, one dramatic headline. But what you've just seen across these cities tells a different story. Housing markets don't fall apart because of one event. They weaken when multiple pressures line up and quietly overpower confidence. When you zoom out, the same checklist appears again and again. Start with prices versus wages. When home values rise faster than local incomes for too long, the market becomes dependent on belief rather than buyers. That belief can hold for years, but once affordability breaks, activity slows before prices ever correct. Stagnation always comes first. Next is fixed obligations. Debt, pensions, and long-term infrastructure costs don't adjust downward when demand softens. They keep pulling cash out of households regardless of market conditions. When those obligations grow faster than the population supporting them, pressure compounds invisibly until behavior changes. Then look at dependency. Federal funding, single industries, or narrow employment bases make markets fragile under stress. When one support weakens, the ripple spreads through housing faster than people expect. Demand doesn't disappear, it hesitates. And hesitation is enough to freeze momentum. Insurance and ownership costs are the accelerants most people miss. Rising premiums, shrinking coverage, and unpredictable expenses don't need to make a city unlivable to damage housing demand. They only need to make ownership harder to forecast. Buyers pull back when uncertainty replaces confidence. Finally, watch population movement. Loud arrivals grab headlines. Quiet departures matter more. Even small outflows reduce the tax base while fixed costs remain unchanged. That imbalance forces higher taxes, reduced services, or borrowing. Each choice pushes the system closer to its limits. None of this points to panic. It points to clarity. The 2025 housing correction isn't a single crash. It's a series of local reckonings where prices, costs, and expectations are being forced back into alignment. Markets that adjust early stabilize sooner. Markets that resist reality grind longer. This is where awareness becomes leverage. When you understand these signals, you stop chasing narratives and start reading structure. You stop reacting late and start positioning early. Now I want to hear from you. Which city or state do you believe is closest to breaking next, and what signal tipped you off? Drop your thoughts in the comments. Different perspectives sharpen this lens. Subscribe and hit the bell, because I'll keep tracking where the next cracks form before they become obvious. Early clarity is the advantage most people don't realize they're allowed to have.